It seems everywhere you turn, there is speculation the Australian resources boom is over, and the outlook is all doom and gloom. The Chinese property market continues its correction, leading to some to speculate that the iron ore prices are set to crack, while the collapse in nickel and lithium prices has some fearing that the expected positive outlook for commodities associated with the transition to a low-carbon future may not be quite as sunny as hoped. But as always in the commodity markets, the devil is in the detail. You may be surprised to hear that our broadest measure of commodity prices is up 5% in the year to July. Sure, there's been some meaningful corrections. Iron ore prices are down around 5%, while nickel has collapsed 25%, so is now worth just 3/4 of what it was a year ago. But we also have seen a rally in some commodities. Metallurgical coal, which is used in blast furnaces to smelt iron, is up 6%. Aluminium is up 9%, and copper has rallied 12%, while gold has outperformed all the others to surge 25% in the year. These are not insignificant moves underpinning the strength of Australia's resource sector. It is true, Westpac has long held the view that rising supplies of iron ore, as well as softer demand as Chinese steel production continues to drift lower. Remember, Chinese steel production peaked in 2020 and has been drifting lower since then. But our low is of $85 a tonne in 2025, still higher than the government's forecast of $62 a tonne, and at least for the near term, we see an upside risk to that forecast. Why? The Chinese property market is mostly through its correction, and as such presents only a marginal downside risk to steel demand, while there's a clear risk Chinese administration could enact policies that would stimulate near-term steel demand. In addition, while there's a risk of increasing Brazilian supplies, and from 2025 from the new mine in Guinea, Australian miners have been quick to adjust production not only to focus on the most profitable ore seams, but also to manage supply and manage prices. We also note a lack of supplies in the met coal seaborne market as Australian production appears to be capped out with little scope for expansion. This lack of met coal expansion has been supportive of prices and is set to continue to be so at least for the medium term. So we turn to the elephant in the commodities room, nickel. Was not nickel the new resources darling, which would see a rapid lift in demand over the next decade as it was increasingly used in batteries needed for the electrification of our economies? Some major miners thought so and invested heavily in the WA nickel industry. But long-term investors remember the boom-bust cycle that nickel has always had and appears to always will. This time, the bust was driven by Chinese industry discovering how to use Indonesian laterite nickel in batteries, opening up that cheap source of nickel. This saw Chinese investment surge in the Indonesian nickel industry, boosting supplies and crushing prices. There is little reason to expect this to change unless consumers of battery are prepared to pay a premium for nickel from non-Indonesian sources. Why would this be based so? Well, Indonesian nickel miners are seen to be the most environmentally destructive in the world, and alternatives could be preferable. And we can still see the transition demand for commodities in copper. This is a metal where there's very constrained supply outlook. Mines are expensive with long delays in development, meaning that the outlook is for supply continues to run short of the outlook for demand. As such, prices remain supported. The major alternative to copper is aluminium, which is being supported by robust demand as well as the rising price of energy. The cost of energy used to smelt aluminium is a major factor in its price, and thus energy price rises will have an impact on the price of aluminium. Gold has been an interesting market for as inflation has eased around the world, the focus has turned to the potential rate cuts, boosting investor sentiment, along with increasing geopolitical uncertainty, has seen investors step in and buy the dips, that is buying the low points, helping to push up prices of gold. With our expectations for a Fed rate cut this year and ongoing geopolitical uncertainty, we expect gold to remain well supported this year. We'll be watching to see if it can sustain a push above $2,500 an ounce. All up, we're expecting commodity prices to soften this year. Falling iron ore and coal prices will be the main driver of a 12% correction by June next year. However, we expect prices at that point to be the low point of commodity prices, with prices rising from there as the cost of production remains a constraint while demand overall remains sound. Falling production of carbon-based energy will keep prices higher than you'd expect given falling demand in fossil fuels.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published, or reproduced in whole or in part without the prior written permission of Westpac.